The danger of American debt isn't waking up tomorrow and finding everything wiped out. The danger is worse. It's about making an irreversible decision in an attempt to protect yourself from a problem you don't yet fully understand. Because when people feel the system is breaking down, they look for anything that seems safe: cash, bonds, stocks, gold, Bitcoin, real estate. Any promise that gives a sense of control. But the feeling of control can be expensive. If the United States government needs to pay more and more to borrow money, what happens to your mortgage? If cash starts yielding more returns, why would anyone still risk money on stocks? If Treasury bonds have always been treated as the safest place in the world, why are so many people looking at them with fear? If an investment pays 5%, but inflation at the supermarket, on gasoline, in rent, and in car insurance seems much higher, is that protection or just a slower loss? If you want to understand economics without having to be an economist, subscribe to the channel, because here we translate financial chaos into decisions that make sense in real life. The question in this video is not whether the United States will collapse tomorrow. The question is more useful: where should you consider putting your money when even what seems safe starts to raise doubts? Because the biggest threat now may not just be US debt. The greatest threat may be the behavior of an ordinary person trying to protect themselves in the dark. It's like selling everything in a panic and then watching the market go up. It's about letting money sit idle out of fear and watching inflation erode purchasing power month after month. It's buying any asset that someone on the internet called protection. It's like locking up short-term money is something that can fluctuate precisely when you need it most. It's confusing return with security. It's confusing pessimism with intelligence. It's confusing a frightening headline with a financial plan. And that's why the question, where should I put my money now, needs to be answered differently. There is no single magical place. There is no single asset that can solve public debt, high interest rates, inflation, recession, cost of living, layoffs, and retirement anxiety all at the same time. What exists is function. There is enough money to survive. Money for opportunities, money for immediate goals, money for retirement, money for protection. And that's money you can't afford to lose, especially when life gets more expensive. Inflation doesn't have to destroy your money all at once. It just has to convince you to stay put. The market can survive a massive debt crisis. The average investor, however, might not survive their own panic. So before we talk about cash, bonds, stocks, gold, or Bitcoin, we need to understand why this debt is so bothersome, not as some distant economic theory, but like a budget problem that somehow creeps into your installment payment, your credit card bill, your job, your 401k calls, and your peace of mind. While interest rates are low, the situation seems manageable. No one panics because the installment is still within reach. But one day the interest rate will change. The same debt that seemed under control is starting to weigh more heavily. The family didn't go bankrupt because they bought one specific thing. They started to go bankrupt because the cost of continuing to roll over the debt became higher. The logic is similar with the American government. The United States spends more than it collects in revenue. This difference is called a deficit. To cover this shortfall, the government issues debt. In practice, it sells Treasury bonds, which are government securities. Those who buy these bonds are lending money to the government in exchange for interest. For a long time, this worked because the whole world wanted to buy this debt. Pension funds were buying, banks were buying, foreign governments were buying, ordinary investors were buying. The dollar was strong, treasuries were seen as a safe haven, and low interest rates allowed the system to breed. The problem is that debt doesn't disappear, she wins. And when it's due, it needs to be paid or refinanced. Refinancing means exchanging an old debt for a new one. Except now the new debt comes with higher interest rates. It's like switching from a low-interest credit card and discovering that, on the next bill, the bank wants to charge much more to continue lending to you. This is where US debt stops being just a giant number on the screen. The problem isn't just owing trillions. The problem is paying more and more to remain in debt. When investors look at persistent inflation, high deficits, and a government that seems unable to spend less, they demand a higher return on their loans. Not for dramatic reasons, for mathematical reasons. If perceived risk increases, the price of money goes up. And when the American government pays more to raise money, everything around it adjusts. Mortgage fees get more expensive, companies are paying more to take out loans. Credit cards continue to suffocate families. Startups and indebted businesses are cutting costs. The real estate market is stalled. And the average investor starts looking at their own portfolio without knowing if they are overprotected or overexposed. That's why public debt doesn't get stuck in Washington. She goes down to the street, it appears, in the rental agreement, in financing, in the price of the insurance. No fear of layoff. I'm unsure about the 401k. That strange feeling of watching the market go up while real life gets tighter. And here's the part that confuses a lot of people. When treasuries pay more, they seem attractive. After all, if the government pays 5%, why risk investing in stocks? But if the actual inflation you're experiencing seems higher than that, then those 5% don't seem like wealth, they seem like anesthesia. Cash is protection in the short term, but it can turn into quicksand in the long term. Therefore, before asking where to invest your money, you need to understand what this crisis is doing to your behavior. Because the next risk isn't just in interest rates, it's in your reaction to them. When everything seems unstable, the brain doesn't look for the best strategy. It looks for relief. He wants a quick answer. They want someone saying buy this. Someone wants to say sell everything. You want a simple solution to a complex problem. But money doesn't forgive decisions made solely to alleviate anxiety. This is where many people get lost. People see a market downturn and think, I need to get out before it gets worse. That's loss aversion. The pain of seeing your portfolio plummet outweighs the logic of remembering why that money was invested. A temporary drop begins to feel like a permanent threat, then comes the recency bias. If the latest headlines talk about debt, inflation, high interest rates, and recession, it seems that the entire future will simply be a continuation of that. Investors forget that markets change, cycles change, interest rates change, governments change, and that today's panic rarely provides a complete picture of tomorrow. Then herd behavior appears. Everyone's talking about cash, so cash seems safe. Everyone's talking about gold, so gold seems inevitable. Everyone's talking about Bitcoin, so Bitcoin seems like salvation. Everyone's saying the market is going to crash, so selling seems prudent. But following the crowd is not the same as having a strategy. Sometimes it's just a matter of outsourcing the fear. And there is also the search for certainty. This is perhaps the most seductive trap. Because in a scenario of high debt, confusing inflation, and interest rates squeezing everything, anyone who speaks with too much confidence seems intelligent. That confidence in one's tone of voice is not proof of accuracy. The influencer doesn't know their deadline. The bank doesn't know anything about your life. The government doesn't know your bill. The algorithm doesn't know how long you can tolerate seeing your wallet plummet without making a mistake. Therefore, the question where should I put my money now can be dangerous when it stems from panic. Because it's usually accompanied by a hidden desire. Tell me one place where I never have to feel afraid again. This place doesn't exist. Cash may offer short-term protection, but it loses effectiveness against inflation in the long term. Bonds can generate income, but they can suffer if interest rates rise further or if you choose the wrong maturity date. Stocks can build wealth, but they can also crash just when you're emotionally fragile. Gold can serve as protection at times, but it does not generate income. Bitcoin can rise significantly, but it can also shatter the calm of those who don't understand its volatility. The problem isn't being afraid. The problem is turning fear into strategy. When you put all your money into a single narrative, you're not protecting yourself. You're betting that there's only one possible future. And the future rarely respects our need for certainty. That's why the next step isn't to choose a winning asset. The next step is to separate your money by function. Because the same dollar can have completely different roles depending on when you need it, the risk you can accept, and what would happen if it fell at the wrong time. You look at your account, see a stagnant amount of money, and start searching for the perfect explanation. But that same money could be a reserve, a down payment on a property, retirement savings, an opportunity, or a safeguard. And each of these functions requires a different approach. The first type is survival money. This is the emergency fund, the money that pays for rent, mortgage, groceries, gas, insurance, medicine, and basic bills if something goes wrong. If you lose your job, if you're laid off, if your car breaks down, if a medical emergency arises, that money needs to be available. It can't depend on the mood of the market. Here, the priority isn't getting rich. It's about not being forced to sell investments at the worst possible time. For some people, this means 3 months of expenses, for others, 6. For those with unstable incomes, dependent families, or real fear of job loss, perhaps 12 months makes more sense. The second type is short-term money. This is the money you will use in the coming months or up to 2 years. Down payment, college, moving, taxes, major purchase, already planned expenses. This money shouldn't be in a place where it could drop by 20% just when you need it. It doesn't matter if someone said the market always goes up in the long run. Your time frame might not be long. The third type is medium-term money. This category includes goals with a 2 to 5 year time frame. This money can accept some risk, but it cannot be treated as a gamble. This is where many people get confused about bonds, because the yield seems attractive, but the term matters, duration matters. If you lock in long-term bonds without understanding the risk of interest rates, you may discover that something safe also fluctuates. Blindly chasing yield is a sophisticated way of making a simple mistake. The fourth type is long-term money. This is retirement money. From 401ks, from index funds, from contributions you don't intend to use for 10, 20, or 30 years. Here, the biggest risk may not be a short-term downturn. It could be leaving the market out of fear and never really coming back. Crises are frightening, headlines scream, wallets flutter. But if money is truly for the long term, it needs a long-term strategy, not a reaction to the week's news. The fifth type is protection and optionality money. Some people allocate a smaller portion of their portfolio to tips, gold, Bitcoin, commodities, or other assets that can act as a hedge in certain scenarios, but none of them are magic. Gold can remain stagnant for years. Bitcoin can plummet. Commodities can fluctuate wildly. Tips also carry risks. Protection is not a guarantee. It's a possible layer within a plan, not a religion. If you also feel that the market is going up, but real life is getting more expensive, leave a like and comment below. What is your biggest dilemma today? Cash, bonds, stocks, gold, Bitcoin, or paying off debt? Because the answer doesn't begin with action. It starts on time. It starts with the job. It begins with what would happen to your life if that money were to disappear, freeze, or lose purchasing power. And in the next part, we're going to turn that into a simple decision map for the average American. While you're looking to earn 5% somewhere, you might be paying 20%, 25%, or more somewhere else. In this case, before trying to appear smart in the market, perhaps the smartest decision is to stop the bleeding. Second question, do you have emergency funds? Because investing without reserves is like building the second floor of a house when the first floor doesn't even have walls yet. If you depend on your next paycheck to survive, any drop in salary becomes a threat, any layoff turns into despair. Any emergency forces you to sell assets at the worst possible time or resort to credit cards. The reserve does not exist to maximize returns, it exists to buy time. Time to look for a job, time to negotiate. It's time to not accept the first bad solution. Third question, will you need this money within 2 years? If so, that money shouldn't be betting on market sentiment. It can be tempting to see stocks rising and feel like you're falling behind. But money with a set due date needs predictability. Down payment, tuition, moving expenses, surgery, taxes, renovations, that kind of money can't depend on hope. Fourth question, is your time horizon longer than 10 years? If the answer is yes, then today's headline cannot dictate your entire strategy. This doesn't mean ignoring risk, it means respecting deadlines. Those who invest for retirement cannot act as if they will need the money tomorrow. A long-term 401k should not be treated as an emotional cash reserve to alleviate short-term fears. Fifth question, does your portfolio depend on a single scenario? If you only win if inflation falls, that's a gamble. If you only win if the Fed cuts interest rates, that's a gamble. If you only win if the gold price skyrockets, that's a gamble. If you only win if Bitcoin becomes the new financial system, that's also a gamble. A true strategy doesn't require only one future to happen, She survives in different scenarios. Sixth question: are you buying because you understand or because you're afraid? That question hurts because many people call fear conviction. People buy gold because they are afraid of the dollar. Buy Bitcoin because you're afraid of the government. Keep your money in cash because you're afraid of the stock market. He buys stocks because he's afraid of missing out on the price increase. But if the decision stems solely from fear, it will likely change when the fear changes, and that's the problem. For the average American, the priority isn't beating all the investors on Wall Street. The priority is to avoid being forced to sell at the worst possible time. It's about not carrying expensive debt while trying to invest. It's about not putting short-term money risk in the long term. It's about not letting your entire financial life depend on a single narrative. It's about not buying products you don't understand just because someone spoke confidently about them. Ultimately, the answer isn't to put everything in cash, bonds, stocks, gold, or Bitcoin. The answer is to separate by function, deadline, and risk. Survival money needs to protect your life. Short-term funds need to protect your plan. Medium-term investment needs to balance security and growth. Long-term money requires patience. Protection money needs to be small enough that it won't destroy you if you're wrong. And in the last part, we need to talk about the hardest part: how to behave when everyone seems to be screaming crisis. If your strategy changes every time new news comes out, you don't have a strategy. You have a reflex, and reflection doesn't build wealth. Reflexo sells through fear, buying, not enthusiasm. Believe whoever speaks the loudest. Go after the asset of the week. And then he calls regret a learning experience. Therefore, the first rule is simple. Don't make big financial decisions on a day when you're panicking. When you're afraid, write it down before you act. What happened? What has really changed? What is the purpose of this money? Do I need it now or in 10 years? Am I reacting to a fact or a feeling? These questions seem simple, but they create distance between you and the impulse. The second rule is to have a personal investment policy. It doesn't have to be complicated. It could be a page. How much do you keep in reserve? How much do you invest per month? What is the time frame for each investment? What would make you rebalance? What would make you change your plan? And, most importantly, what will you not do when you are afraid? Because the worst time to create rules is in the middle of a fire. The third rule is to rebalance instead of reacting. Reacting means watching the market fall and trying to run away. Rebalancing means looking at your strategy and adjusting it methodically. Something is born from fear, the other one is born from a plan. The fourth rule is to reduce leverage. Debt can accelerate wealth accumulation when everything is going well. But when interest rates rise, incomes tighten, and the market turns against you, debt becomes a leash. The more you owe, the less freedom you have. And in a slow-moving crisis, financial freedom is not a luxury. It's protection. The fifth rule is to protect liquidity. Having cash available doesn't mean being a coward. It means not being forced to sell a good asset at a bad time. But don't turn cash into a religion either. Cash provides protection in the short term, but its effects can be eroded in the long term. Absolute security does not exist. What exists is balance. The sixth rule is to diversify by function, not by trend. Don't buy gold just because someone said the dollar is going to die. Don't buy Bitcoin just because someone promised freedom. Don't buy bonds just because they seem safe. Don't buy stocks just because everyone says they'll go up in the long run. Understand the role of each thing: protection, liquidity, growth, income, optionality. When every type of money has a purpose, you stop looking for a magic answer. And perhaps that's the biggest turning point. Don't confuse pessimism with intelligence. Some people seem clever because they always predict disaster. But if you spend your whole life waiting for collapse, you might also miss out on years of growth. And don't confuse optimism with strategy. Believing that everything will always work out is no substitute for reserves, risk management, and debt control. A mature investor is not one who never feels fear. It's the one who feels fear and yet doesn't hand over the steering wheel to him. US debt could continue to grow. Interest rates may remain high. Inflation may continue to be a problem. The market can go up even when real life seems worse. And that's exactly why you need to stop asking only where to put your money and start asking what each part of your money needs to do for you. survive, wait, to grow, protect. Take advantage of opportunities. That's the difference between reacting to the system and building a financial life that can withstand the system. Now comment below where you feel this pressure the most: rent, groceries, credit card bills, or investments. Leave a like if this video helped you think more clearly. And watch the video that's appearing on the screen now, because it picks up exactly where this one ends.